Alright, let's talk about something truly, deeply terrifying. No, not a spider wearing a tiny clown wig, although that is horrifying. I'm talking about financial reports. Those dense, soul-crushing documents that look like someone translated a phone book into a language only robots and your dad's accountant can understand. Imagine this, it's 11 p.m. on a Tuesday, you're staring at a spreadsheet. The numbers blur into abstract shapes, whispering your deepest insecurities. You were supposed to understand this an hour ago. Now you're not even sure you remember your own name. Somewhere between amortized goodwill non-recurring revenue, a small piece of your will to live has quietly packed its bags and left forever. This feeling is universal. A small business owner in Ohio checking if she can afford a new coffee machine. A junior analyst in London asked to summarize a 200-page quarterly report. A silent pandemic of numerical confusion. We've all been there, nodding in a meeting, pretending to know what EBITDA is, while our brains play the dial-up modem on loop. The dread is legendary. So, what even are financial reports? You've probably heard the term thrown around in a way that's supposed to sound important, and let's be honest, a little bit boring. At their core, financial reports are supposed to be the report card for a business. But it's not just a simple letter grade. It's the full, detailed teacher's comments, the attendance record, and the list of extracurriculars all rolled into one. They are a standardized set of documents designed to provide a clear, transparent, and comparable look at a company's performance and position. This standardization, governed by rules like the Generally Accepted Accounting Principles or GBEL-AP, is what allows us to compare Apple to Microsoft, or your local coffee shop to the one across the street. It's the universal language of business. And this language is primarily spoken through three main documents, the big three of financial reporting. They are a collection of statements: the income statement, the balance sheet, and the cash flow statement. Each one tells a different part of the story, and together, they are meant to tell you the complete story of a company's financial health. To really get it, let's stick with a simple analogy. Think of it like a doctor's checkup for the business. First up, the income statement. This tells you if the patient, the company, made a profit or a loss over a specific period like a quarter or a year. It's a summary of performance over time, like a movie of the company's operations. It starts with revenue, all the money the company earned from sales. Then, it subtracts all the expenses it took to run the business, things like salaries, rent, and marketing. What's left at the very bottom is the famous bottom line: net income. Was it positive? Great, a profit. Was it negative? Not so great, a loss. In our checkup, this is like checking the company's temperature. A healthy profit is a normal temperature, while a big loss could be a raging fever. Next, the doctor looks at the balance sheet. Unlike the income statement, this isn't a movie, it's a snapshot. It tells you what the company owns, its assets, and what it owes, its liabilities, at a single moment in time. Assets are things of value, like cash in the bank, inventory waiting to be sold, and buildings or equipment. Liabilities are debts, like bank loans or bills from suppliers. The difference between these two is equity, which represents the owner's stake in the company. This leads to the fundamental accounting equation. Assets always equal liabilities plus equity. It has to balance, hence the name. In our checkup, the balance sheet is like taking the company's blood pressure. Too much debt or liability compared to assets can signal high risk, high blood pressure. And the cash flow statement? This one might be the most important of all. It tracks the actual physical cash moving in and out of the company. This is crucial, because profit on the income statement isn't the same as cash in the bank. A company can be profitable on paper but go bankrupt because it runs out of cash to pay its bills. This statement breaks cash movement into three activities: operating, which is cash from the core business; investing, which is cash used to buy or sell long-term assets like property; and financing, which is cash from investors or lenders. This is like checking the patient's pulse. Is it strong and steady from its own operations, or is it weak, relying on constant infusions of cash from financing, like a patient on an IV drip just to make sure they're, not dead? So, that's the what. Now, for the big question, why should you care? Oh, you sweet innocent summer child, you should care because whether you know it or not, these reports are shaping your life. If you own any stock, even if it's just tucked away in a retirement fund like a 401k or an IRA, you are an owner of those companies. The fund managers who invest your money live and die by these reports. A company with growing profits and strong cash flow from operations is a good bet. Its stock price is likely to rise and your nest egg grows. A company showing consistent losses and burning through cash, its stock price will likely fall and your nest egg shrinks into a sad little robin's egg. Understanding the basics helps you see if your investments are built on solid rock or shifting sand. If you work for a company, its financial report is a window into your future. It can decide whether you get a raise, a bonus, or a cardboard box to pack up your desk plant. Is your company consistently profitable? It's more likely to have money for raises and promotions. Is it losing money year after year with debt piling up on the balance sheet? That's a huge red flag for job security and a potential sign of upcoming layoffs. Knowing how to read the signs can give you a critical head start in managing your career. And it's not just about big corporations. If you dream of starting your own business, this is the language you'll need to speak. These reports are how you'll prove your idea is viable, how you'll get a loan from a bank, and how you'll attract investors. They are the blueprint for your own financial success. On a grander scale, these reports are the bedrock of our economy. They inform governments on how to collect corporate taxes, which fund our schools, roads, and hospitals. They tell banks whether to approve loans that fuel growth and innovation. And they guide the flow of trillions of dollars from investors, directing capital to promising ventures and away from failing ones. In short, these numbers tell a story. A story about success and failure, risk and reward, your job, your savings, and the health of the world we all live in. And that's a story worth learning how to read. Let's get into the nitty-gritty of why reading a financial report feels like a punishment. I mean, a real soul-crushing, I'd rather be doing my taxes kind of punishment. It's that feeling of staring at a dense, alien document, knowing there are important secrets hidden inside, but having no idea how to unlock them. You feel like you're being tested and you're certain you're about to fail. But here's the thing, it's not you, it's the report. The whole system is practically designed to be intimidating. It really boils down to three main culprits: the three horsemen of the accounting apocalypse, confusing jargon, too many rules, and just so many damn numbers. First, let's tackle the ringleader of this whole mess: the jargon. Oh, the jargon. The language of accounting was seemingly designed by a committee whose sole purpose was to make smart people feel dumb. They use words that sound vaguely English, but have meanings so specific and counterintuitive they might as well be spells from a wizarding school. You see a word like amortization. It's just a fancy way of saying you're spreading out the cost of something you can't physically touch, like a patent or a brand name, over its useful life. Think of it as depreciation but for corporate ghosts, or the infamous EBITDA. It stands for earnings before interest, taxes, depreciation, and amortization. Companies love this one because it's like taking a photo of their finances with a very flattering filter on. It shows you what their earnings would be if a bunch of real-world costs just didn't exist. It's a fantasy number, but it gets thrown around like it's the gospel truth. Then you have deferred revenue, accrued expenses, pro forma earnings. The list goes on and on. It's an exclusive club, and the password is a string of incomprehensible buzzwords designed to keep normal people out. So if you feel lost, remember, it's not just you, it's deliberately obtuse. It's a form of gatekeeping. Then comes the second horseman, the enforcer of the apocalypse: the rules. So many rules. The world of accounting is governed by two massive competing sets of them. In the United States we have GAAP, Generally Accepted Accounting Principles, and for most of the rest of the world there's IFRS, International Financial Reporting Standards. Think of these as two incredibly detailed, slightly different instruction manuals for building the exact same Lego set. The final model looks about the same, but the steps to get there can be maddeningly different, and when I say rule books, I mean rule. Combined, these standards run for thousands and thousands of pages. We're talking longer than the entire Lord of the Rings trilogy, and I promise you, with far fewer heroic elves and a lot more subsections about lease accounting. And they are constantly being updated by committees of very serious people who probably find watching paint dry to be a bit too thrilling. They'll spend months debating the precise accounting treatment for cloud computing arrangements. These rules dictate everything. How do you value an asset? Is that factory on your books worth what you paid for it 20 years ago or what it's worth today? The rules have a very long, very complicated answer. When can you recognize revenue? When the customer signs the contract? When you ship the product? When they finally pay the invoice? The rules have a very strong multi-page opinion on that, and most importantly, what you have to disclose in the footnotes. The footnotes. The footnotes are the fine print of the financial world. They're the graveyard where companies bury all the interesting, scary, and complicated details. Details about major lawsuits, weird one-off events that made their numbers look good, how much debt they're really in. It's all there. They hide it in plain sight, knowing full well that no sane person will ever have the time or energy to read them. And that brings us to our third and final horseman, the one that works with the other two to completely overwhelm you, the sheer volume of numbers. Open any annual report and you are immediately hit with a visual assault, a sea of figures, columns, rows, percentages, numbers in parentheses, numbers with asterisks. It's a blizzard of data. The scale is baffling. Millions, billions, sometimes with so many zeros your eyes just glaze over and your brain checks out. And the numbers themselves lack context. A company reports $10 billion in revenue. Is that good? Is it more or less than last year? How does it stack up against their biggest competitor? A single number is meaningless. It's a data point without a story. The real story, the actual insight, isn't in any one number. It's in the relationships between the numbers, how they change over time, and how they connect across the different financial statements. So you have impenetrable jargon, a labyrinth of rules, and an avalanche of numbers. It's no wonder we run for the hills. But here's the good news. There is a way through this maze. You just need a map and a flashlight, and that's exactly what we're going to build for you, starting with the most important document of all. The anatomy of a mistake. Now, in a system this complex, mistakes aren't just possible, they're basically inevitable. They come in all shapes and sizes, from the laughably small to the catastrophically large. Sometimes it's a simple typo, a misplaced decimal point, one extra zero, 1 million instead of 100,000. A single zero can be the difference between profit and massive loss. Think of it like this. Recipe says 1 cup, you read 10. The result is not a cake. A sugary abomination you chisel off the counter. That's what a financial typo is like, but with lawsuits. Then there are subtle errors from misunderstanding rules. Maybe a company recognizes revenue too early. They book a big contract now, though the work takes 3 years. According to the rules, that's a big no-no. Pressure to hit quarterly targets is immense. People bend the rules. They call it creative or aggressive accounting. So, what happens when people get it wrong? When they misunderstand a report, when a mistake goes unnoticed, when a lie goes unnoticed? The consequences aren't just numbers on a page changing. The fallout is real, and it affects real people. Let's take the example of a small investor. Let's call her Susan. Susan has saved up a little money, wants to invest in a company that looks promising. She pulls up their financial report, sees big revenue numbers, sees what looks like a healthy profit. She invests her savings. But buried in footnote 37B was a detail. The profit came from a one-time factory sale. The company's core business is losing money. The stock price tanks. Susan's savings evaporate. You might think that the people who do this for a living, the accountants, the auditors, the financial analysts, must love this stuff. That they glide through spreadsheets with the grace of a figure skater, their minds a beautiful symphony of numbers. You would be wrong, so very, very wrong. Talk to any junior accountant during busy season, which seems to be about 11 months of the year, and you will see a shell of a human being, fueled by caffeine and a deep, abiding fear of their senior manager. They spend their days ticking and tying, which is a real term for matching numbers from one document to another, over and over and over again. It is the definition of mind-numbing work. The pressure on these professionals is immense. They are the gatekeepers. The auditors, in particular, are supposed to be the independent referees. Now let's talk about the rest of us, the normal people, the civilians in this war on comprehension. For us, the struggle with financial reporting often starts much closer to home. It starts with trying to understand your own pay stub. You see your gross pay, and you feel a fleeting moment of joy. But then you look at your net pay, and the joy is gone, replaced by bewilderment. What is FICA? Why is there a deduction for something called LTD? It's your own money, but the statement explaining where it went looks like it was written by the same people who designed the IKEA instructions. It's the first sign that the world of finance is not designed for you. This feeling of helplessness extends to almost every major financial decision in our lives. Trying to choose a mortgage? Option 1, lower interest rate but higher closing costs and something called points. Option 2, higher rate but no points. The bank hands you a stack of disclosure forms so dense with legalese they could be used to press flowers. You end up just picking one and hoping for the best, trying to choose a health insurance plan, deductibles, co-payments, co-insurance, out-of-pocket maximums. Okay, so it's a complete mess. And I don't just mean a little disorganized. I mean it's a labyrinth designed by a committee of sadists, a dumpster fire wrapped in a spreadsheet. Opening a company's annual report feels like being handed a 300-page legal document written in a dead language with the expectation that you'll just understand it. It's an act of aggression disguised as transparency. The sheer density, the endless tables of numbers marching off into infinity, the footnotes that have their own footnotes. It's all designed to make you give up, to make your eyes glaze over and your brain shut down until you just wave your hands and say, "Fine, whatever, you're the experts." But it doesn't have to be this way. This isn't an unsolvable cosmic mystery. We can fix this. We have the tools, we have the knowledge, and we have the collective need. And the solutions don't even require a complete overthrow of capitalism, although let's keep that on the table as a backup plan. In fact, these fixes would make capitalism. A market can only be efficient and fair if its participants are well informed. Right now, we're forcing people to make multi-billion-dollar decisions in the dark, and that's not just bad for us, it's bad for the entire system. So, how do we turn on the lights? I see a three-step path forward. The first and most obvious step is radical simplification. We need to demand clearer communication. The complexity isn't an accident, it's a feature. It creates a kind of financial priesthood, a small group of accountants, analysts, and executives who can speak the secret language of EBITDA and non-GAAP earnings. This gatekeeping protects their jobs and allows companies to control their own narrative. We need to break that monopoly. How? Companies should be required by law to produce a plain English summary of their financial reports, a one-page document right at the front that explains in simple terms the answers to the questions any normal person would ask. Did we make money? How much cash do we have? Where did our revenue come from? What are the biggest risks we're facing? What's our basic plan for next year? No jargon, no acronyms, no creative accounting. Instead of saying we realized negative organic growth in our legacy verticals, they should say sales of our older products went down. Instead of we're optimizing our human capital resources, just say we're planning layoffs. Just the facts, presented in a way a human being can actually understand. It's about respect. Respect for investors, for employees, and for the public. Second, we need to drag financial reporting into the 21st century. We need to embrace technology and data visualization. We live in an age of incredible design. We have phones that can recognize our faces. We have apps that can identify a song playing in a noisy bar. We have refrigerators that can tell us when we're out of milk. So, why do financial reports still look like they were designed in 1985 on a dot matrix printer? It's absurd. The static PDF is a relic. The future is interactive. We need interactive reports. Imagine clicking on a revenue number and seeing a graph that breaks it down by region and by product. Imagine hovering over a term like goodwill and having a simple pop-up box explain what it is, with an example. Imagine a story mode that walks you through the company's year, highlighting the major events that impacted the numbers. Or a simple simulator where you can drag a slider for sales growth and see how it would impact the bottom line. This isn't science fiction, this technology already exists. The tools to build these experiences are widely available and used every day for internal business dashboards. It's time to make them public-facing. And that brings me to the third and most crucial step, accountability. Great ideas are useless if no one is required to implement them. Companies won't do this out of the goodness of their hearts. The current system, as confusing as it is, serves the interests of those in power. To change it, we need to apply pressure. This starts with regulators, like the SEC in the United States. They have the power to mandate what companies must disclose and how they disclose it. They mandated the hundreds of pages of complexity. They can just as easily mandate one page of clarity. It also comes down to us. As investors, we can use our power. We can support shareholder proposals that demand these changes. We can choose to invest in companies that prioritize transparency. As employees, we can ask for this clarity from our own leadership. And as citizens, we can create a public outcry, demanding that financial information, which has a huge impact on our economy and our lives, be made accessible to everyone, not just the experts. So, simplification, visualization, and accountability. It's a clear path forward. The technology is here. The design principles are understood. The only thing missing is the collective will to make it happen. This is a fixable problem. Let's get to work. So, here we are, at the end of our journey through the bewildering world of financial reporting. If you've ever felt lost, stupid, or just plain exhausted while looking at a financial document, you're not alone. It's not you, it's them. It's the jargon. It's the rules. It's the endless soul-crushing numbers. It's a system built by experts for experts, and it has left almost everyone else behind. The frustration you feel is a perfectly rational response to a perfectly irrational system. Financial reports should inform us, not intimidate us. We deserve a system that empowers us, not one that makes us feel small.